Good morning. My name is Ruggiero Lomonaco. I'm responsible for real estate and infrastructure funds at Rosmala Investment Bank. Today is the 7th of November 2022, 9:12 minutes in Dubai. So the question today is, can we catch the bottom of the market? With equity markets having corrected about 25% this year, and here is the global, the FTSE EPRA Global REITs Index, which is down about 33%, 33% this year. So a number of commentators are asking if the October low was the bottom of the market. If so, we are not far away to catch it and benefit from the recovery which typically follows a bear market. The big uncertainty comes from the fact that the Fed keeps communicating that they are not done with raising interest rates. And indeed, market participants now expect that policy rates will continue to rise all the way to 5% and probably a bit more. So under these conditions, it is not unthinkable to have a renewed period of weakness and retest the October lows. Now, what is the appropriate strategy in such an uncertain period? The answer is to average in, i.e., spread the capital to invest over a 12-month period to avoid being overexposed in case the market falls further, and try to capture as many observation points. Now, I have been calling for some time an overweight on the listed real estate and infrastructure sector as a way to generate a superior return over the next cycle. Listed trusts and closed-ended funds active in these sectors have been really battered this year when the real rate, that is risk-free rates minus inflation, turned positive. However, now these securities seem to have fully discounted the higher rate environment and offer an attractive long-term total return, in my opinion. With Q3 ended, most of the listed real estate and infrastructure securities I follow have reported their results, and the general feeling is that things are going quite well in their portfolios, with occupancy low and income rising. After all, in an inflationary environment, the income of real assets tend to rise. So see, for example, the dividend per share of Prologis, which keeps accelerating as a result of continuous growth of their net operating income. Now, besides logistics, there are a number of sectors which are attractive. Now, here, the healthcare is another sector which keeps receiving consistent buy ratings by equity analysts. This sector benefits from secular tailwinds like aging population and increased demand for healthcare services. Healthcare properties are specialized and typically leased on a long-term basis to tenants providing security of income. So, for example, here I have Alexandria Real Estate. It's a REIT that specializes in life science properties in key clusters like MIT in Boston University. Here as well, you can see a steady growing dividend yield, dividend per share, sorry. Now, another sector we like is the residential sector, which benefits from the secular tailwinds of urbanization and shortage of supply due to planning constraints which limit developments of new housing. Rental income is usually considered very secure because housing is an essential need, and tenants risk eviction if rental payments fall in arrears. So, for example, here you can see I've selected NextPoint's residential, which has delivered a double-digit growth of their dividend per share over the last 3 and 5 years. The trouble net lease sector has changed a lot over the last few years. While in the past the focus was on offices, net lease REITs have increasingly pivoted their portfolios towards the real estate sector, and in particular towards essential retail, which is less affected by the rise of e-commerce. So one such REIT I like is Reality Income Trust, which has assembled a formidable portfolio of trouble net leases diversified across multiple sectors and has managed to deliver the consistent dividend per share growth. They are really every month really they try to increase their dividend. Now, on the listed infrastructure sector, one of my favorite theme is that of digital infrastructure. The sector benefits from the secular tailwind of digital transformation. Every aspect of modern life is digitized, increasing the need of infrastructure to store, elaborate, and transmit data. So the specialized nature of digital infrastructure assets means that demand for space is very stable. So as an example of a security I like, I have put here on the slide the Digital Reality Trust, one of the largest developers and operators of hyperscale data centers. Again, here you can see a very attractive dividend yield already, 4.98%, and a very interesting growth of that dividend over 3 and 5 years. One black cloud that I'd like to flag here, nobody's talking about, but I believe we might hear a little bit more. With the big tech starting to cut back on their labor force and their growth plans being less aggressive than initially thought, we might have some repercussions on the digital infrastructure that supports those techs. So as I said, so far I haven't seen anything written, commented, but there is a possibility that might be some issues there. But anyway, similarly, let's have a look at American Towers Corporation, which operates telecom towers around the world and is benefiting from tremendous growth following the rollout of G-Mobile networks. This is really a traditional telecom business, but rather than using cables, uses telecom towers. So again, you can see a very, very strong double-digit return of the earnings per shares over 1, 3, and 5 years. Now, you might have noticed that I have selected a number of REITs with an indicated dividend yield, i.e. the yield that is expected over the next 12 months, below the current 10-year treasury, which was quoting 4.15% last Friday. This is not a coincidence. Smart REITs investors don't look only at the current dividend yield. They actually look at the growth of the dividend per share. In fact, I was talking some time ago with the chief investment officer of the listed infrastructure business of CBRE Investment Management, Jeremy Anagnos, and he was mentioning that according to their research, focusing on high dividend REITs might actually lead to underperformance. In their opinion and their research, dividend growth is a much better indication of future outperformance. So why is that the case? Well, let's go back to basics. Over the course of 2022, virtually all listed real estate and infrastructure companies in our coverage have repriced substantially. That is because real rates, that is, nominal rates less inflation, have become positive, and the required rate of return of the securities has increased. Now, to give you an example of the change, have a look at the real rates today versus 2 years ago. Here, what I have done, I went on Bloomberg and I have taken the swap curve, this R, and I compare it to the inflation swap curve, so the expected rate of inflation. So the difference between R and P, this R star, is my real rate of return. Now, there is an element of credit premium into this because the swap curve in reality reflects the credit rating of the banks quoting those swaps. But what is important really to see is that by moving the time to exactly 2 years ago, okay, those numbers were negative. So we were in a negative real rate of return. So whilst the rise of inflation will eventually filter to rents and boost the growth of companies owning real assets, such a dramatic increase of real rates logically required a downward adjustment of prices. But the adjustment is done. So at this point, positive real rates are factored in the valuation of the securities under our coverage. So in addition, this company generates a spread, which is a reflection either of the credit risk of their tenants, when the asset they own is let on a long-term basis, or simply of a property risk premium. So let me, this shows better. So the total return that we are expecting from a real estate security is made up of the real rate of the property risk premium, which, as I said, for long income assets usually is approximated to a great extent by the credit premium of those tenants, and then there is the liquidity premium. These three components together give us the cap rate. So when we compare the returns of our properties, of our universe, to the fixed income, we use the cap rate, and we can say, yeah, the properties are yielding less or more than the current nominal rate, risk-free rate. But what is important is the growth. The growth, which can be approximated and estimated through a number of factors. The simplest one is the inflation. Okay, inflation can filter into the rents and can determine the growth of the income, and there are other ways of estimating the growth of each properties. So in other words, the expected rental and dividend growth of our securities can help us to, which also incorporates some element of leverage, can easily help us to set an expectation of a 9 to 10% total return from listed real estate and infrastructure securities. That is a 4 to 5% above the current risk-free rate, and really justifies the allocation to this asset class. Thank you very much for listening. Feel free to reach if you would like to discuss more in more details these topics.